Hello and welcome everyone. My name is Cameron May and I want to welcome you to this inaugural discussion of options learning strategy selection. If you've ever thought to yourself as you're looking at the whole menu of potential options trades, which one would be right for me or for my account, I'm going to try to shed some light on the sorts of thought processes that an investor might go through in making those sorts of decisions. So welcome aboard, and as we go through these initial slides, if you wouldn't mind, just let me know where you're chiming in from. There's Ricardo. Ricardo, always good to have you in class. Thank you for the confirmation. Audio and video is good. John, perfect. All right, so let's get right into it. First of all, options are not suitable for all investors, as the special risks inherent to options trading may expose investors to potentially rapid and substantial losses. Spread, straddles, and other multi-leg option strategies can entail substantial transaction costs you need to be aware of. Also, the characteristics that are typical of spread, straddles, and other multi-leg strategies, you need to be aware of those. Trades involving minimal potential benefit can also be significantly impacted by transaction costs. Futures and Forex options trading is speculative. Any investment decision you make in your self-directed account is solely your responsibility. Transaction costs are important factors and should be considered when evaluating any trade. Past performance of any security or strategy does not guarantee future results or success. All investing involves risks, including risk of loss. Finally, a quick recap of our Greeks. Delta is a measure of an option's sensitivity to changes in the price of the underlying. Gamma is a measure of delta's sensitivity to changes in price. Vega is a measure of an option's sensitivity to changes in volatility. And theta is a measure of an option's sensitivity to time decay. Okay, all right, Dave, looks like, hello there, Donna, good to see you. And Ishwar, welcome aboard. Rajesh is there in Chicago. Yeah, I am really looking forward to this discussion series. I have a number of different topics on that, on the concept of how do we choose an option strategy. Number one is just the strategy itself. That's what we're going to talk about today. You know, do signs seem to be pointing toward, you know, buying a call or buying a put or selling a call or selling a put or a vertical spread or a covered call or whatever it might be? How might you go, what might be some of the considerations as you consider those things? But in the future, there's so many other things. You know, which strike prices do you choose? What kinds of stocks would be potentially good candidates or maybe not as attractive candidates for options traders? All those sorts of things. And there's Richard and Eve and William. All right. Well, let's get right to our agenda for today. Let me share my screen. I'm going to pop over here to the Thinkorswim platform. And here's our timeline. Now, I'm going to try my best to adhere to this timeline, although the topics may change from week to week. And I might even change the outline of the timeline. But as for today, here's the way that I have things planned. We're going to spend about 15 minutes, the initial 15 minutes, discussing the concept of strategy selection. And then we're going to apply it to today's market conditions, just so that we can see things through a real-time example, just for sample purposes only. Then we're going to go to some trade illustrations to sort of carry this learning process through to its logical conclusion. And then in future weeks, we're going to spend more time on what we call portfolio management. That is looking at existing trades and seeing what might need to be done with those. And then, of course, I'm going to leave some time for you at the end. Although just because it says question and answer here, you know, after 3:45 Eastern Standard Time, it doesn't mean you have to bite your tongue until then. If you see me not address something that seems pertinent, or if I use some terminology that's not familiar to you, call me out right at that moment. Ask that question, and I'll happily address it if it blends into the flow of the conversation at that point of the discussion. Every once in a while, somebody will have just a one-off, right? That would be it would just take us on a tangent. Those are actually okay at the end of the discussion. All right? Does that sound fair? So let's get to it. Let's talk about the concept. Concept for today is strategy selection. So if you were to talk to 2 or 3 different investors or options traders, and you talk about the thought processes that go through their minds as they're trying to figure out which strategy to settle on, they're probably going to have different approaches. That's okay. So what I'm going to be showing you today is one potential approach and some of the considerations. So let's just start with it. In my view, you might accomplish a lot just with 4 steps taken. Number 1, you have to look at yourself and take a personal assessment of your needs from your options trading. So what are your personal considerations? And what might these include? Well, personal considerations would be like your own personal risk tolerance. With the number of people that we have here in class today, I know that there's probably going to be some on one end of the spectrum of risk and some on the other end of the spectrum. It's going to range from conservative to aggressive, and there's a lot of gray area with options trading, but one of the things that options trading can offer is for you to be able to customize your approach to your particular risk tolerance. And when I say that there's gray area, I can state that, you might hear somebody say, ooh, let's say buying a long call is really aggressive. Well, maybe. But are all long calls built the same? Or are there some that are more aggressive than others? So what you'll have to understand in order to tailor things to your risk tolerance is your particular level of strategy familiarity or strategy comfort. Okay? So these are your personal considerations. How much risk are you willing to take? And then once you've settled in on whether you're conservative or you're aggressive, just sort of by nature, then you can look at the sorts of strategies that you're familiar with and start to tailor it. So it's one thing for me to say, oh, if you're more conservative, then maybe you consider something like a covered call or a vertical spread that's out of the money, like a credit spread. Well, that's fine, except maybe you don't know anything about those strategies. So if you don't know about those strategies, we have courses all throughout the week that'll teach you about the individual strategies. But taking up a personal assessment of what you need from your options trading, that might be a first step. Next up, your portfolio considerations. So once you've taken that personal inventory, maybe now you literally look at your portfolio and determine, is it bullish enough for current market expectations? Or does it need a level of bearishness added to it? Hey, there's Fred. Hi there, Fred. But your portfolio, depending on what you've already invested in or what you're already trading, it might be as aggressive as you want it to be, and that may change the sorts of options that you add to that portfolio. Or market conditions may have changed since you originally constructed that portfolio. Maybe you're seeing a reversal in market conditions, and you think that maybe you need to start adding on some layers of bearish positions. Those sorts of considerations. So, 2 other considerations is: are you looking for speculation, or do you need some hedging? Now, hedging is a strong term. You need to be aware that hedges are not free, but options are commonly used by stock traders, by options traders, to reduce potentially reduce the volatility in their portfolio. But you have to understand the implications for reward and risk when you add even what you consider to be a hedging position. So what is the difference between these two? If you're not familiar with these, a speculator typically invests in or trades options with a hope or an expectation of profits. That's what they're hoping for. Doesn't mean it's guaranteed, right? but that's their motivation for getting into the trade. A hedger has a very different motivation. What is that? A hedger doesn't get in expecting to make money on the options position. As a matter of fact, they might even come into it fully expecting to lose money. No expectation of profits from the options position. They're using their options conceptually to reduce account volatility. Right? That's the goal of the trade. That doesn't mean that's guaranteed what's going to happen. So you have your personal considerations, you have portfolio considerations, and now we're going to get to some stuff. Now I can't do these things for you, obviously. I don't know how risk tolerant you are or what you understand regarding options trading yet. But this next step, I think that I can give you some insights into some logic of how to get this accomplished. Your stock market considerations. Okay, what might the stock market considerations be? Well, do you have bullish or bearish outlook? Hey there, Kathleen. Welcome aboard. And how might we achieve an outlook? Well, there are investors that look at things from a fundamental perspective. And a technical outlook. Okay? So when I'm talking about fundamentals, I mean, let's say you've been following the markets, you're keeping tabs on what's happening with the tensions between the U.S. and China. You're looking at economic releases and keeping track of employment situation. You're looking at CPI and PPI and GDP and all of those numbers. So if you're the sort of investor that keeps track of those sorts of things, you may have a specific fundamental outlook that could contribute toward whether you're doing bullish or bearish options trading in general. So what we're going to do in this class, we are going to take a look at things technically. And then finally, once we have at least some sort of context, as long as we think that we have some context on the stock market, we might also look for the options market for context or considerations. So I got to ask you, those of you who are veteran options traders here, what is something that an options trader can look to get a feel for whether, let's say, options are going up or down in price, generally speaking? I think most of us can relate to looking at stock charts to determine whether the stock market is going up or down, but there are actually charts that do they perform a similar function for options and for options traders. Where might an options trader or investor look to get a gauge on the relative trend of options prices and the relative cost of options? For that, you might look to a volatility index. An example of that, exactly, Dan and Donna, like the VIX. Okay, so I'm going to leave these first two items primarily to you, but now it's about 1/4 past the hour. It's time to go to our market review, and let's apply some of these this is sort of theory at this point, right? Really is just theoretical. So let me ask you, as we turn our attention over here to the S&P 500, what is your outlook? Let's say I were to ask you whether you think the markets are going to be higher 30 days from now or lower 30 days from now. What would you say? You might ask, why am I asking about 30 days? Well, a lot of options contracts have run their course in the next 30 days. So if you tend to trade in that time frame, it might be useful to try to get your finger on the pulse of the markets, to try to come up with some sort of forecast for the time frame that you intend to have your trades. Okay, so think about that. So I'm going to look over here at the S&P, and we'll just start to look at things technically. Now, if you don't feel terribly comfortable with technical analysis, then I would definitely encourage you to join me on Monday nights. It's actually not Monday night, that's an exaggeration. It's Monday afternoon. I teach a class every Monday. It's 4 o'clock Mountain Standard Time, 6 o'clock Eastern Standard Time. It's a 30-minute discussion called Getting Started with Investing. Okay, Kathleen says, sheesh, Coach, I want to say higher. Higher, maybe? Well, it's all just an educated guess, isn't it, Kathleen? Yeah, so there's not a wrong answer here, but let's look at what the markets have been doing. The S&P had this great run. Let me switch my drawing tool. There was a big run from these lows up to this peak. We had an all-time high on the S&P 500. Now, I'm going to change the thickness of this line. Let me show you a little trick here, because I know that those lines can be difficult to see from your end if it's very thin. So I'm going to right-click on that. I'm going to activate that drawing from the resulting menu. Actually, that's not what I wanted to do. I wanted to oh, actually, no, you know what? I'm going to leave that where it is. Hold on a second. Let me delete that. Remove that second drawing. I was about to go on a different tangent, and I think I'm just in the interest of time. Yep, we have 14 minutes for this segment. We hit this peak in, when was that, late January, and then sold off pretty hard down to the low in early February, and then we've had a consolidation since then. We ran up to a peak and then down to a low. We ran up to a peak. Oops, let's try that again. Up to a peak right here, down to another low. And so how would you describe this? How would you describe this trend right now? Well, it depends on how you're drawing your highs and your lows, because it looks to me like we had higher highs right there, but there may be other investors or other technicians who might just say, yeah, but that wasn't really a high and a low. We're just going to connect this in one solid move from this low to that high, not really recognizing this as a pullback. That's going to be a bit of a, there you go, Yusuf. Yeah, what I'm applying here, and we talked about it yesterday, is called Dow theory, right? It's just analyzing the highs and lows within market moves. Okay? But in any event, if we look at these two prominent peaks and then these two prominent lows, we have maybe lower highs and equal lows. Or if you were looking at this, you might have higher highs but lower lows. Either case, what you wind up with is a sideways trend, right? If you have lower highs but equal lows, that's a sideways trend, according to Dow theory. If you have higher highs but lower lows, once again, sideways trend. So if we're in a sideways trend, maybe we look to see, are we closer to support or closer to resistance? And in just a quick snapshot view, doesn't this look like maybe we're closer to a support level? Maybe have more potential upside? I could be wrong. Again, opinions are going to vary on this. But what I'm doing here is I'm just going through a technical analysis of market conditions to try to get some feel for how I feel about the markets. So let's just say that as a group we determine that we're bullish. Well, that might be something interesting to make a note as we're making our decision for our options trading. So let's make a note down here. Let's just say, for argument's sake, that we have bullish. This is the S&P. call that the bullish outlook, okay? Let's take a quick peek at the other markets. Let's look at the other indices. I'm going to flash up here to the Dow. It generally works tends to move kind of in lockstep with the S&P. Not exactly, but generally speaking. Here's the Dow, lower highs, equal lows. And then as we move to the NASDAQ, I think the NASDAQ is a more prominent example of just having the higher highs but lower lows. But same effective outlook. So I think let's just say for today's discussion that we have the SPX, the Dow, and the NASDAQ. Let's say that we have a bullish outlook. That's a stock market expectation. What about the options market? I'm going to switch over here and bring up what's called the VIX. Now, a lot of investors have never heard of the VIX. So I have to take a little extra time to explain exactly what this is. When you go to the VIX, and this class is called learning strategy selection. So I can't assume that everybody already knows this stuff, right? The VIX is a chart of how volatile the S&P is being. Now, why do I care about how volatile the S&P is? Well, because the stock market, the options market, generally has a very strong correlation to the volatility of the stock market. As volatility increases on the major exchanges, what generally happens with the prices of options? Yeah, William's already doing a little bit of technical analysis on this, right? But as volatility goes up, options prices typically go up. And that's true for calls, or it's generally true, generally accurate, for calls and for puts. So why is that? Well, because think about the pricing of options is related to the demand for options. And when volatility spikes, the demand for options typically spikes as well. And that's from the speculator side of things. Options speculators and options hedgers typically have greater demand as volatility increases. Speculators demand more options because they see that volatility as creating additional potential for their positions. So they're willing to pay higher prices, they're willing to buy more contracts, generally speaking. Hedgers, well, think about a great big money manager. As a matter of fact, put yourselves in the shoes of a great big money manager. Let's say that you're managing a $500 million portfolio and you have a lot of stock positions, and you notice the markets are getting more volatile, and you start to think, wow, maybe I ought to reduce the volatility in this account or in these positions. What's one of the ways that you might choose to do that? Well, you might go out and engage in some options strategies in an effort to reduce that volatility in the account. If you do that, it drives up the demand for options, and that drives price for options. So speculators and hedgers will tend to drive demand up as volatility goes up, and that drives prices. So when you're looking at this volatility chart, when you see volatility really high like it was right here, what's this going to cause you to think immediately? Prices are probably high, right? So that may give you some indication regarding whether it's a better time to buy or potentially a better time to sell. Let me ask you, just generally speaking with anything, is it better to sell when prices are high or sell when prices are low? We're talking about artwork, real estate, whatever, right? When prices are high, that generally speaking is a more favorable environment for sellers. So think about what was going on with options prices being very high here. It means literally for buyers, things are expensive. For sellers, maybe the premiums that they're collecting by selling options were very high. Now imagine pairing that information with your expectation for the stock market. Well, if you have a bullish outlook on the stock market, that's great. But that might tell you, well, I want some sort of a bullish strategy for my options. But you can buy options and be bullish, and you can also sell options and be bullish. So how do I decide whether I'm going to buy or sell? Well, this might be used as a tool for helping with that decision. So look at where we are right now. Would you say that options prices, would you say that volatility is relatively high or relatively low, or is it somewhere in the middle? Well, looking at a one-year chart, this would seem like the lows were down here. Right? Let me just draw in a little quick line here. Lows are down here. And for whatever reason, it is not accepting my other click. There it goes. The highs were way up here, and it might look like we're sort of right in the middle. Right? However, you might look at this through a different lens. Most of the options or most of the volatility activity has been down at the lower range. I would say in an absolute perspective, there's been far less volatility above where we are right now than below where we are right now. Does that sound fair? So options prices are probably a little higher than normal right now. Okay? Now, William is saying, it says that things are sideways and they're heading up. Yeah. And I think, William, were you the one that noted that we might have a potential double bottom right here? Yeah. So you can take that next step and try to gauge whether you think we're going to go higher or whether we're going to go lower, or you might just look at the absolute position. Okay? And it also might be helpful to look at a different time frame. If you bring this up on let's go to maybe 3-year, but let's leave it on a daily chart so we can still see where we are right now. Yeah, you can see here we are. This volatility spike over the last several months is the only time that volatility has been above this level, boy, since about early 2016, with a few rare exceptions. So I think that a lot of options traders might look at this and say, yeah, options prices are still pretty high. So let's add that to our outlook. We have high volatility, or in other words, high options prices. So let's just do this final bit of math here. If we are bullish, plus we have high prices, which strategies might be a good application for both of these assumptions? We think the markets are going to go higher. Now you might have a different opinion. When I say we think, that's just sort of just to illustrate this concept, right? And I should be specific here, high options prices. So if you're bullish on the stock market, but you notice the options prices are high, then that might be a time when an options trader might look to sell puts. Does that make sense? Now you might be saying, so for our options traders, they're going, oh yeah, that makes perfect sense. For someone who's never traded options, you might not know why that brings things together. Well, when you are bullish on the stock market, the two basic option strategies, there are lots of bullish option strategies, but the two most basic are buying calls and selling puts. Okay? Buying calls, great, except prices are very high right now. Doesn't mean you can't make profits. It just means that potentially or conceptually it might be a little bit harder, right? Selling puts is also bullish. I know that a lot of people think puts and they think bearish. No. Calls and puts are not inherently bullish or bearish. because in each transaction you have a buyer and a seller. One of them is bullish and the other one is bearish. That's true of calls and puts. With a call contract, the buyer is bullish and the seller is bearish. With a put contract, the buyer is bearish and the seller is bullish. So we're just taking a quick assessment of the stock market and the options market to tell us, as much as we can tell, whether to be bullish or bearish, and whether we should be a buyer or a seller. Okay, so that's sort of the logical process that a lot of options traders will go through. So let's go put this into practice. So if we're bullish on the stock market, you might also carry that logic forward and look for bullish stocks, right? If you're going to do a bullish strategy and you go out and pick something that you think is about to collapse, that might not be a productive thing to do. So let's go to our watch list here. And what I typically do in these classes, just to keep things simple, I'm going to, now William, you could do that, buy protective puts if you're bearish, right? Yeah, but if you're bullish on the markets, buying protection conceptually might be reserved for another time, right? Okay, so let's go to our public watch list. I'm going to go to the S&P 500. That's just to give us a random selection of stocks. I'm going to organize these by last trading price, and I'm going to scroll down to, let's say, the mid-range prices. Let's go to stocks trading for around 100. Now, if you're wondering, well, what sorts of stocks might options traders look for, you want to make sure that you join me next week. That's what we're going to talk about. Today we're just talking about strategy selection. We're not talking about the kinds of stocks, conceptually the kinds of stocks to trade options on. But let's go through just a few stocks here. How about we look at, I don't know, Walmart. Let's bring that up. I'm going to link my watch list to my chart, and notice we're keeping right here with our timeline. Perfect. Half past the hour. Moving on to our trade examples to illustrate these concepts. But the way you link your watch list to your chart, click on the little button right here. On your screen, it might just look like a link, like a chain link. And I'm going to select a color. It doesn't matter which color. I'm going to come over here and make sure that I have the same color on the chart. And now these two things are linked. You'll notice it automatically loaded up Walmart. And if I were to go down here to, let's say, Darden Restaurants, click on that, it just automatically loads Darden here, so I don't have to type in the symbols. So, you know what? Actually, since we're here on Darden Restaurants, I think I'm going to stick with this one. See if you follow my technical logic here. With Darden, does that look like a general upward trend? Would that be kind of in keeping with our market expectation from what we saw? And you might not draw the trend line exactly the same place that I did. You might draw one that's a little bit shorter term right here. Yeah, it looks like we have kind of cyclical highs and cyclical lows. Sold off to a low right here. And this is still, is this a 3-year chart? It is, yeah. So these are pretty long cycles here, lasting on the order of several months. We ran up to a peak, sold off down to a low, ran up to a peak, sold off down to a low, and although there's never a guarantee, let's just run with the assumption that this sort of a rhythm is going to hold into the future. You can see that was the case back here. So does it seem fairly logical that an investor might look at this and say, okay, well, Darden Restaurants looks like it might be set for a bullish move? Yeah. Let's switch this to a shorter term time frame. Now that we've seen the longer term, let's go to maybe, let's say, a 6-month chart. Just going to give us a closer view. All right. Now we've had that pullback, that cyclical pullback, and we're bouncing and starting to rise again. Now it could be, you might have a technical expectation that we've run up already from 82 up to close to 88. You know, that's a good 7.5% move. Maybe we're going to pull back for a little bit. But let's talk about selling a put. A lot of people relate to buying calls. I'm going to kick off this series of discussions by talking about selling a put. So selling a put, as I mentioned, is a bullish strategy. I'm going to come down here to my scratch pad, buy myself a little bit more real estate down here. And let's just say that we have a bullish expectation for Darden, just like we did for the markets. And that we want to be on the selling side of the markets rather than on the buying side, because if volatility is high, if it were to come down, that's actually damaging to the sellers. To the buyers. Because if prices come down and you already bought the option, it can reduce potentially the value of that option that you bought. So I'm going to go to my trade tab, type in our symbol DRI, and I'm going to look for an option. We could get into a contract lasting 10 days all the way out to 647 days. How about we look at this one, these contracts that expire on the 18th of May. Let's open up the number of strikes to a few more here. And you'll notice if you've never traded options before, the calls are on the left, the puts are on the right. I would assume that most of you have, since you're in here in a discussion of how do we select our strategy. So let's go over to our puts, and let's maybe look at selling. For my example, I think I'm going to go with maybe this 82.5 put. Okay. So we're going to sell the 18th of May, 82.5 put, and that right now is trading for somewhere between $1 and $1.15. I'm going to be a little bit generous. Say that we get $1.10 out of this trade. Okay. So why is this a bullish trade? Two questions. Why is this bullish in keeping with our stock market expectation? And and why does this benefit from high volatility? And of course, you got to always say, why does this potentially benefit? Right? Okay. So first of all, why is it bullish? Well, because when you sell a put, you're getting paid a credit of $1, in this case $1.10. When you're getting paid, obviously the other party is expecting something from you. In this case, the specific obligation that you're making is you're obligating yourself to buy shares for $82.5. The other party has the right to put shares to you for $82.5. All right, so that sounds fine. You have a stock that you're bullish on. The stock's already trading at $87-ish. And okay, Ishwar asked a great question. What would you want to say in the open interest before choosing which strike to sell? Ishwar, great question. That's actually going to be a topic of discussion for another day. All right, that's on the docket. Next week, we're going to talk about stock characteristics that you might look for your options trading. And then the week after that, strike selection and open interest could be helpful there. Okay. Yeah, so Fred, our expectation is that the stock price could go up. And as a matter of fact, our hope is that it does. Because if it does, what's going to happen with this obligation that we have? We've collected $1.10 per share. Each contract is 100 shares, so that's $110 that's been paid to us. But we have an obligation. No matter what the price of this stock is, the other trader has the right to sell us shares for $82.5. Now, if the stock goes up as we expect it to, are they ever going to sell us those shares at $82.5? No, they're not going to be motivated to. If the shares are worth $90 a share, they're not going to enforce the terms of their contract. They're not going to enforce their right to sell us shares at $82.5. it's only if the price comes down, and specifically if it goes down below 82.5, that the other party in this transaction is going to be motivated to force us to buy shares at 82.5. For example, what if the price fell to $75? And we're getting close to this 18th of May expiration, or we get right to it. Is the other trader who has the right to sell us shares for 82.5 going to do it if they're only worth 75? Of course they are. Matter of fact, if you had expiration and a stock is below 82.5 by even a penny, those shares, those contracts are going to get exercised, and you will be required to buy the shares. So this is a bullish trade because it works out best at expiration if the stock is above 82.5. How far above 82.5, it actually doesn't matter. It just makes you feel better. The further it gets above 82.5, the better. Okay, so why does this benefit from high volatility? Well, we already talked about the pricing of options influenced by volatility, and with volatility being comparatively high right now, this $1.10 is probably more than we would typically get. If we were to drop the volatility, it actually affects the value of that option. Let me show you a little tool here. I'm going to come up here to the layout and net change, and I'm going to choose a tool that's called Theoprice. Has anybody used Theoprice before? Theoprice is a great tool if you've ever wondered to yourself, boy, I wonder how much would I make on this option if the stock price were to go up by $1 or $2? Or how much would I lose on this option as time goes by? Or how much would I make or lose as volatility goes up and down? This theoretical price tool is a calculator that allows you to make those sorts of projections. And it uses the Black-Scholes formula to calculate. Yeah, Donna says you love this. William uses it. Basil uses it. Yep. I have a question for you. What if volatility were to drop 10%? How much do you suppose that would impact the value of our option? Well, by choosing Theoprice, you'll notice right over here, I can click right where it says Theoprice. It has a date box, it has a stock price box, and it has a volatility. That's not volume, it's volatility box. And I can change these different variables. So let's say, boy, I wonder what would happen to the price of my option if volatility were 10% lower than it is right now. I'm going to put in a minus 10% and then just click somewhere else in this tool. And what just happened behind the scenes is this told me how much that volatility change has affected the pricing of my option. Look at the option contract that we're dealing with. If the volatility were lower right now, would I still get $1 or $1.10? Nope. We'd be looking at 27 cents for the same obligation over the same period of time. That completely makes sense. Because if the stock is behaving very calmly, right, the other trader might not have to pay you as much to entice you to get into an obligation to buy the shares at 82.5, because you might think, well, geez, the stock's barely moving. It's probably not going to get down to 82.5. And even if it does, it probably won't go much lower than that. On the other hand, if the stock is chopping all over the place, the other trader is probably going to have to pay you more to entice you to take this position. That is the impact of volatility. So I just wanted to illustrate that. So why does this potentially benefit from high volatility? Let's say high vol equals higher options prices for sellers. I don't know why I capitalized each one of those, but I did. All right, so there is our trade for the day. Let's put that in. So I'm going to click on the bid price. That creates the sell order for our contracts. Each contract that you do is going to obligate you to buy 100 shares of dry ships. I'm just going to dial it down to one contract, so at the most I'm obligated to spend $8,250 to buy 100 shares of dry ships. I'm going to submit this as a market order. Yep, there's a risk when you submit market orders because you don't know exactly the credit or the amount that you'll have to pay in the case of you're buying shares or buying contracts. But I'm going to confirm and send. Selling one dry ships, 18th of May, $82.50 put. Let's send that off. And there we go. All right. So we're now in that position. And the best outcome for this dry ships position is for that stock price to start to climb. Right? That's why we looked at the charts. Now, even if the stock price isn't climbing, what else could benefit? What else could help this trade? What if volatilities were to start to fall again? If volatility falls, that actually also is helpful for this trade. Falling volatility is potentially harmful to buyers, potentially helpful to sellers. All right. So what do you think, class? So far, so good? We have some steps for selecting a specific option strategy, and I think you can see how taking a quick pulse of the stock market, a quick pulse of the options market might help you start to narrow the potential strategies. There are definitely some others we could have chosen. There are other bullish option strategies that are primarily selling strategies. Can anybody name those? See if you can name one of those, because I can't cover them all in a single session. What do you think? Somebody want to take a stab at that? Other bullish selling strategies. We have, of course, we just did what's called a naked put. What about a bull put spread? That's where you take that naked put and then you cover it using another put option. Also known as a short put vertical. Thank you, Fred. Basil says covered calls. Yes, interestingly, a covered call, although the option itself is a bearish trade, the stock ownership on the whole makes the entire position effectively bullish. Yeah, very good. So maybe covered calls. Maybe call diagonals. Very similar to a covered call. All sorts of things that you could do. All right. Well, class, so we don't have an inventory to manage at this point. What we're going to talk about in future weeks, you'll notice in this last 15-minute segment, I've allowed some time for portfolio management, but we don't have a portfolio to manage yet. Next week, we'll at least have this trade to talk about. What questions do you have for me? Eve, it's buffering. That's not good. I don't like to hear that. I hope the stream is still solid and strong for everybody else. Well, while you're thinking over those questions, I want to give you an invitation. If you want to hang out for just the next 10 minutes, John McNichol is going to be teaching a class for active traders, and it's called Understanding Market Conditions, and he's going to review concepts like volatility, earnings, and news. So if you feel like you need a little bit of context there, John is always fantastic, right? Okay. But also, I'm going to give you an invitation. Join me next week. We're going to talk about the sorts of characteristics in a stock that an options trader might look for. Some stocks may be more favorable for potentially for trading options. Others may have inherent shortcomings. There might be some pitfalls that we might want to look out for. John, is that a question? Bonds for portfolios for options? Hey, Donna, I'm glad to be doing it too. I'm looking forward to it. I'm going to try to be deliberate just like I was today. We'll go in a step-by-step manner. Ishwar says, do you have to register for John's class? No. You know how it'll click when you want to go to a class, it'll say register, but all you have to do is put in like your name and an email address, and then you're in. And if you save that, it won't ask you again. That's if you're joining through the TD Ameritrade site. That's about it. That's the most you'd ever have to do. John, I'm not sure. Bonds for portfolios for options. I'm not sure exactly what the question is. Are you just asking about bonds in general? Because I see that you're putting in like AAA, BBB, like bond ratings. That I don't teach a lot about bonds, so I'm afraid you might have hit me a little bit of blind spot. I'm not sure what I might offer there. All right. Well, class, I'm actually going to set you loose, so maybe go get a quick drink, get a breather, and then reconvene. John's going to teach you some good stuff, I am certain, about volatility, earnings, news. Yeah, Ishwar, you should just be able to stay in. Yep, you don't need to log out of the channel. I'm going to end this broadcast. John will kick off a new one in just a moment, and you'll just see it start to broadcast again. All right. So everybody, I will see you next week. A final quick reminder of the risks associated with your trading. There we go. Slides 1, 2, and 3. And I'm looking forward to talking with you next week about stock characteristics. So have a great week. Good luck. And until I see you next time, happy investing. Bye-bye.